AUC 240 is the auditing standard for managing fraud risks in audits. The standard is very important because it clarifies who is responsible for preventing and deterring material fraud in the financial statements. AUC 240 evolved from SAS 99 and was created right after Sarbanes-Oxley became law. That's important. SOX is the law, AUC 240 is the audit standard. Both came out of the same fraud crisis era, and they work together. SOX requires companies to strengthen controls, while AUC 240 requires auditors to test whether those controls actually address fraud risk. Let's start with the auditor's role in detecting fraud. AUC 240 requires auditors to approach every audit with a skeptical mindset and sound professional judgment. That means understanding the company, assessing fraud risks, and tailoring audit procedures to those risks. As part of those steps, auditors review the company's 10K and 8Q industry developments and board and audit committee meetings as part of their audit risk assessment and fraud evaluation. They integrate this information into their understanding of the company, management's incentives, and where misstatements might occur. Think of it like buying a used car. You don't just trust the seller's word. You pop the hood, kick the tires, and take it for a test drive. Auditors do the same. They pop the hood on internal controls, test transactions, and evaluate how management views fraud risk. The goal is to detect material misstatements and enhance the credibility of financial statements. The two pillars of fraud management that AUC 240 emphasizes are prevention and deterrence. Prevention is like locking your doors. Internal control, segregation of duties, and monitoring transactions make it harder for fraud to occur. Deterrence is more like security cameras and consequences, reminding people that fraud will be caught and punished. Together, these reduce both the opportunity and the motivation for fraud. Let's go deeper, though, into what fraud prevention and deterrence actually look like in practice. On the prevention side, companies should design internal controls that reduce opportunities for fraud, separating duties so no one person can initiate and conceal a transaction. Like, for instance, the person responsible for invoicing should not be the person also responsible for collections and posting cash receipts. Other internal controls include restricting system access, running background checks on employees in sensitive roles, and continuously monitoring financial activity. That means that the company, for instance, needs to be able to prove that bank statements and bank reconciliations are regularly reviewed and approved. On the deterrence side, the focus is on influencing behavior. That means providing whistleblower hotlines, enforcing strong anti-retaliation policies, and making sure employees know that fraudulent behavior has consequences. Tone at the top is critical. When leadership models ethical conduct and reinforces ethical behavior in training classes, it sends the message that fraud will be both detected and punished. Auditors may ask the executive team to provide proof when such messaging occurs, like, for instance, company meetings, communications, mission statement, training, and so on. Together, prevention reduces the opportunity for fraud, while deterrence discourages people from even attempting it. To be clear, the company, governance, and management share the duty to prevent, detect, and deter fraud. AUC 240 stresses cutting down chances for fraud while increasing the likelihood of catching it. But the standard is evolving. In July 2025, the ASB issued an exposure draft of a new SAS to replace AUC 240. It puts auditor fraud responsibility front and center, gives more explicit guidance on responses when fraud is identified, and strengthens expectations for professional skepticism and audit team skills. In practice, this would mean more documentation and justification. Auditors will need stronger evidence for their judgments about fraud risk, overrides, estimates, communication, and so on. Management needs to maintain documentation and be ready to support those judgments. It also would require earlier detection and response because auditors must be continuously alert and must have procedures ready when fraud is suspected. Timing matters. Management should ensure ongoing monitoring and timely reporting of concerns. There is a higher expectation for governance. Audit committees and boards will have to be more engaged, more informed, because the standards want governance to be part of the loop regarding fraud risk, reporting mechanisms, and response. In addition, the exposure draft considered stronger alignment with international standards. The ASB is considering alignment with ISA 240 revised, so companies with global footprints may see more consistency. And because of more procedures, retrospective reviews, more documentation, enhanced communications, oversight, audits may take more time and potentially more costs in terms of audit fees to cover the increased requirements. Management may need to plan for that. For smaller firms or companies, some of these enhanced requirements might be challenging to scale. With all the focus on preventing and deterring fraud, it might be surprising that there is still so much fraud occurring. Auditors test controls and only sample the data and provide reasonable assurance. It might make you wonder if we need a different approach to protect investors and other stakeholders. An interesting example of a different approach is Germany. Germany's tax system takes a very different approach from the US. Companies must hand over a complete data set of transactions so regulators can run their own analysis. And with AI and enhanced computing technology, this should not be that difficult in the US either. In theory, at least, this should make fraud harder to hide and perhaps deter some fraudsters. Yet the case of the German company Wirecard shows it's not foolproof. Wirecard, once a fintech superstar, claimed huge profits from payment processing. In reality, though, large parts of its reported revenue and cash balances, over 1.9 billion euros, were fabricated. They created fake third-party partners in Asia and invented transactions. When auditors finally pressed for independent bank confirmations in 2020, the money wasn't there. Wirecard collapsed into insolvency and became the first DAX 30 company ever to collapse due to fraud. The DAX in Germany is the equivalent of the Dow Jones Industrial Average. The CEO was arrested and the COO escaped on private planes and went into hiding under assumed names. This case highlighted that regulators ignored red flags and auditors relied too much on documents from management instead of independent verification. The lesson, even in countries with stricter data requirements, smart fraudsters can still find ways around the system. Technology and regulation help, but they don't replace professional skepticism, strong governance, and auditor persistence. To sum it up, the AICPA's AU-C 240 makes it clear. Preventing and detecting fraud isn't the auditor's job alone. Quite honestly, I'm not quite sure why anybody would think that. But just to be clear, AU-C 240 states that it is a shared responsibility. That means that the company's governance, including the board and audit committee, provides oversight, sets the ethical tone, and promotes transparency. The company's management designs and implements internal controls, ensures segregation of duties, and fosters a culture of honesty. Auditors then step in to evaluate whether those measures are effective and if fraud risks are adequately addressed. Ultimately, the goal is the integrity of financial statements, which underpins investor confidence, accurate decision-making, and an organization's credibility.